Asos put out an early profit warning ahead of its actual third quarter trading statement. They told the market that they would not meet their previous guidance on EBIT margins, that's operating margins. They had forecast that they would this year hit a 6.5% margin. Now they're talking that down to 4.5%. Overall, the impact is to knock roughly 30% off of earnings estimates for the full year, and guess what? Stock went down 30% in the morning.
The online market is changing. It's becoming more sophisticated and there are new players and increased competition. Asos discounted quite heavily last year, and this didn't sit well with some of the brands that it sells online. Across the industry, the brands are wanting to take far more control of their online distribution. It's also facing more competition from Next, which has set up a third-party branded site.
The problem slightly has been the foreign exchange headwinds that the company is feeling as it's tried to expand over the years internationally. It's also tried to adapt its pricing in the various markets where it has to play. And when sterling, its home market, has been stronger, they've had to try to discount in other markets such as Australia. They've tried to implement what they call a zonal pricing plan, and that there was some software that they wanted to implement. That software has been late. That's hit profits, they said.
Asos faced increased capital expenditure and increased investment to stay relevant and to increase its international reach. It's investing in China, which is not an easy market to crack. It's investing in new infrastructure, and this is all going to weigh on its profitability going forward.
They've also said that actually we don't expect these margins to bounce back up into the 6–7% area anytime soon. So a permanent reduction in operating margins, I think, would have a serious impact on valuations over time.